Okay. So in the last class regarding globe income, we just discussed which accounting standard to use, what is the starting point of globe calculations, etc. So just a small pop quiz. What is the starting point of globe calculations? What is the starting point for globe calculations? Okay, I'm receiving answers. Just now says globe income. So I'll say is net globe income. No, no, I won't say if we have the financial statements. No, so what is the starting point for calculating globe income? I don't know. Globe income is a starting point for charging provisions on allocation, etc. I'm not talking about chapter two. I'm talking about chapter three. How do we find globe income? From what would we start? So Ashik says net profit or loss after tax expense. Melvin says after tax. Okay. So is it P&L figure bottom line or OCI bottom line? It's the P&L bottom line. Okay, don't not OCI. Perfect. So that is the starting point. This is what we learned, and we also dived into few other things like which accounting standard to use. How to go about deciding that there are something called authorized standards. Then there is acceptable standards which to use. What is permanent difference rule of 1 million, and then there is CMD, competitive material distortions rule of 75 million. I hope you remember all that. Let's not go there. So we were just putting some flavor as to identifying what is the starting point. Now there is one more critical question: which net profit after tax? Is it the consolidated net profit after tax or something else? Just to refresh and bring us back into perspective, consolidated net profit or loss, or net profit or loss from the financial accounting records of somebody else. How do we start? Net profit and loss of whom? Why is the chat silent? Yes, nobody, somebody, anybody. Okay, what is the hierarchy for charging mechanism? What is number one? It's jurisdictional, then entity, then parent, right? So I'll says of the each constituent entity. Absolutely, we will start with net profit and loss of each constituent entity. Okay, because once we find each globe income, then we total it and find the jurisdictional globe income, and then we will do whether it is 15%, then allocate between entities, and then go to parent. We learned about all of this in chapter two. So you have to take each constituent entities net profit and loss. First calculate globe income, and then we will accumulate for jurisdictional globe income. Is that clear? Can you give me an yes or no? Okay, fantastic. Now, why I'm asking all this is to bring you into perspective, because this, my friends, is not very easy to learn. And what you have to understand is this is more of IFRS and less of taxation. So if you are very good at IFRS, it would be easier for you to understand this. If you are not, don't worry. Nobody is an expert in anything. You ask me promptly why it was not clear to you, and I would be more than happy to explain. Okay, with that, let's start. Now, what is the title of the chapter is mandatory adjustments. Okay, after completing this chapter, you would be able to identify and apply all mandatory adjustment required to convert financial net loss, net income or loss to globe income or loss. Okay, what is the conversion is what we are discussing. Okay, so we will take help of corporate tax. Okay, in CT, what is the starting point? Starting point is net profit and loss, or accounting income is the starting point, correct? And then we have some pluses and minus. You remember what are the pluses and minuses? Can you give me some examples? How to? It is the first page of your computation. What are the adjustments that we do in accounting income that results in getting us taxable income? What are the few in our domestic tax law? I'll give you a few. Participation exemption, right? Then small business relief. I won't call it as an adjustment, but revenue itself is changed, so it's not an adjustment. But qualifying group relief, business restructuring relief, right? Realization, loss or profit option that we take. You remember all that? If you don't remember all that, then we are in grave danger, friends. So, same we will see from the accounting net profit and loss. How do we calculate global income? Okay, so this is the picture that you have to understand. And since it is accounting income, which is the top line, or that's the starting point, it is predominantly IFRS. Okay, so shall we start the adjustments? Mandatory adjustments to be needed. Did you understand the background of the whole discussion? Yes, so this is the focal point which you should be concentrating. So, what is the first? Yeah. So, while Globe framework takes financial accounting as its starting point, it does not accept that starting point uncritically. Okay. Article 3.2, which we will be discussing in whole and whole today, prescribes a series of mandatory adjustments that transform financial accounting net income into globe income, a measure specifically designed for minimum tax purposes. These adjustments reflect policy judgments about which item should be included in the profit base subject to 15% floor and which should be excluded or modified. Understanding the rationale behind each adjustments illuminates not just what you do mechanically, but why framework treats different income types differently. So it's all about rationale. If you don't understand why this is added or deducted, feel free to ask me. We'll take time to understand. If you don't understand, this is the core. Okay, if you don't understand, then please let me know and we'll be more than happy to discuss it again. With that understanding, what should be the first adjustment? You tell me. What should be the first adjustment? First adjustment, my friends, is okay. For or like we'll give you an overview first. Okay, so there are like 10 adjustments that you need, and first adjustment is net tax expense because we're doing it after tax. We have to make it before. So first one is net tax expense, then excluded dividends, equity excluded equity gain or loss, included evaluation method gain or loss from disposition under Article 6.3, asymmetric foreign currency gains and losses, policy disallowed expenses, prior period errors, and change in accounting principles, accrued pension expense, and stock based compensation. So there are 10 mandatory adjustments. We will discuss each adjustment today. Okay. So the first one is net tax expense. Now, why should that be a adjustment? Is because the net tax expense recorded in financial statements must be added back to the financial accounting net income. Why? Because you see, what is the objective of globe income? To find out the ETR. Correct? How do you find the ETR? Taxes divided by globe income. So if the same taxes or covered taxes, as we say, is included, is adjusted, then would it give a correct picture? It should be net profit before taxes, which we should be which should be the denominator. Correct? So that is the whole rationale. So you could ask me better than why would we start with we could have started with net profit before tax, right? Why are you doing net profit after tax? That's because this net tax expense has a lot of inclusions. Okay. So financial net profit is an after tax figure. Since globe income feeds into ETR calculation that divides the adjusted cover taxes by globe income, the tax expense must be removed to create a pre-tax expense. Okay. Now let's come back to the question. Why can't we take a pre net profit before tax? And do why should we do after tax and then add back taxes? That's because, my friends, not everything is a cover tax. Okay, because what should you add back? current tax expense, foreign taxes, withholding taxes, or tax provision or accruals which are there as a part of your P&L. These, see, if you take current taxes, in your financial statement, it would have all of these, right? So we only need to add back current tax, foreign tax, withholding tax, and tax provision. Basically, something of a direct tax nature. You should not exclude deferred tax because it has a separate treatment. We'll discuss that in the next chapter. Okay, deferred tax adjustments. You don't add back deferred taxes, non-income taxes like VAT, customs, payroll. It is very rare that you find VAT as an expense. But end of the day, if yes, if you are paying VAT for which you are not getting a credit, no need to exclude that. And also other taxes like property taxes or luxury taxes. Those things don't add back because simple reason because it is not a cover tax. Okay, so you understand why we are taking after taxes and then adding certain taxes, because not all taxes in the financial statements are to be excluded. You have to cherry pick and deduct it. Clear? Yes or no? Okay, fantastic. So the first adjustment is adding back taxes. Okay, always I would be trying so hard to push the rationale, understand the rationale why. Don't by heart it. It's not worth it. Okay, you guys are very smart. So understand the rationale. And what is the second adjustment? This is the first adjustment. So 1 out of 10 completed. Now let's go to 2 out of 10. Okay. Second adjustment is excluded dividends. Now let me stop there. This is something similar to CT, right? We have something called participation exemption. So any dividends which I get as a result of participation is excluded. Correct? Now, for participation, I have to have more than 5% ownership or being controlled. And if it is a domestic dividend, it is excluded irrespective of the ownership or anything. Correct? So, why would you tell me why is dividends excluded in UACT? Why is dividends excluded in UACT? Absolutely. Sahil says it's already taxed. Just now says because it may already been taxed. Obviously, absolutely 100% I'm with you. Since it is already taxed, we don't need to. Even though in financial statements it would be an income if we receive dividends, so we are excluding it. The rationale is spot on, but there are few shortcomings. Like the rule, dividends and similar deductions are excluded unless they are from short-term portfolio shareholding. We'll explain all that. Okay, so what is an excluded dividend? Dividend is excluded if either the M&E group holds greater than or equal to 10% of profits, capital, reserves, or voting rights, or if the ownership is held for lesser or greater than or equal to 12 months at the dividend date. So if I either have 10% of profits, capital, reserves, or voting rights, or I, even if I don't have 10%, if I hold it for 12 months or more at the time of dividend rate, at the time of issuance of dividend, then yes, it can be excluded. So this is just like participation exemption, correct? So you should have either a participation or it should be a long-term dividend from a long-term asset. So if either of the conditions are satisfied, then it is an excluded dividend. Okay. Now, what is a short-term portfolio shareholding? It is anything other than this. So, a short-term portfolio shareholding is something where the ownership is lesser than 10% and it is held for lesser than 12 months. In such cases, it is you don't exclude that back from your net profit. Okay. But anything other than portfolio shareholdings, you can exclude it. Clear? Is, and in terms of excluded dividend, it is or. So either 10% profits, 10% of shareholding, or 12 months of holding. That is why here it is and, correct. If both of them are not satisfied, then only it becomes a portfolio share. Okay. So let's do an example. Let's say that this is my dividend source. So my dividend source is from AQ, which is in Ireland. I have 60% ownership and I have held it for more than 12 months. Should I exclude this dividend from my net profit? Yes or no? You have to, because it satisfies the conditions. Now I have dividend coming from listed company A. Ownership is only 2% and the holding period is 3 years. Should I exclude this dividend? Yes or no? Yes or no? Okay, Ashik says yes, Sahil says yes, Jasno says yes, because it is satisfying this condition. Now let's go to listed company B. I have a 5% ownership and I've held it for 5 months. Should I exclude this dividend? No, because it does not satisfy both conditions and it is what we call as a portfolio shareholding. Okay. Now listed company C, I have 12% ownership, but I have only having a holding period of 2 months. What about now? Can I exclude? Okay, Sahil says yes, Ashik says yes. Yes, you have to exclude my friend because you have more than 10% ownership. Are you getting? So it is just like participation exemption, but a little twist here. Instead of 5%, you have to understand it should go to be 10% or holding for 12 months. Okay, fantastic. Now, with respect to portfolio shareholding election, now there is a option, just like you have options in CT, there are a lot of options which is given in Globe Income also. Now, what is this portfolio shareholding election? Now, an M&E group may elect to include all portfolio shareholding dividends in Globe Income. Okay, this is a 5-year election that simplifies compliance by avoiding the need to track holding periods. So, what they are trying to say is, if I have any portfolio shareholding, okay, which is less than 5% or less than 10%, then what I could do is I could, opt that all the portfolio shareholdings are not to be excluded. It would be taxed. So what will happen is, if I take an option, that option is valid for the next 5 years. And what will happen is I don't have the need to see what is the ownership date for each holding. Getting it? It's a lot of compliance issue for me to understand whether it is more less than 12 months or more than 12 months on the dividend date. To avoid that, what I could do is all the portfolio shareholdings, or technically shareholding, I can kind of say, no, no, these are all portfolio shareholdings only. So what I'm going to do, I'm going to take this option. I don't mind that being included in my global. So that I can do to avoid the pressure of calculating this 12 months thing every year. Okay. I can do this also. So it simplifies compliance by avoiding the need to track holding periods. So when should you consider this election? If you're having high value portfolio investments, so many portfolios, so many shares, so many companies, then yes, it makes sense. Administrative burden of tracking holding period exceeds tax benefit. Absolutely. Right? If it is just small, I have 1% shareholding and I get 1% of the dividends, then just saving that is very difficult. Like, the time that I take to track holding periods exceed the tax benefit I get, or portfolio dividend are minimal relative to the total. So, in such cases, you can have an option to not do this 12 months or, every time. You can say, boss, it's taxable. Anything lesser than 10% shareholding, I'll just offer. I don't need to kind of see whether it is meeting 12 months condition or not. Clear? Yes. Yeah. So the dividend exclusion, yeah. And again, this is what you guys said. The dividend exclusion implements a fundamental principle of international tax, avoiding double taxation of corporate profits. When a subsidiary earns profit and pays tax, then distributes that dividend to its parent, taxing the parent on dividend effectively taxes the economic profit twice. Right? The 10%/12-month test act as filters. Substantial long-term shareholdings represent genuine investment relationships where double taxation concerns are strongest, while short-term portfolio holdings may look more like trading positions where inclusion is appropriate. The framework mirrors participation exemptions found in many domestic laws. Clear regarding the second adjustment. So you have to look for whether you have any income in the nature of dividends and apply the holding period rule and identify which are portfolio shareholdings. If those are portfolio shareholdings, don't exclude, other things exclude. Clear? Adjustment number two. Now adjustment number three, when there is dividend, there is one more thing which is adjusted. What is that? It is nothing but, my friends, capital gains. So excluded equity gains or loss. So let's understand what this is. Okay, now let me ask you, does CT law have something like this? Excluded gains or losses? Can I, if I have capital gain from equity investments, do I have an adjustment? So I'll say yes. Okay, which is that adjustment? There are multiple. There is participation exemption as well as transitional provisions also, right? On qualifying financial investment. So same thing. Let's understand excluded equity gain or loss. Okay. So what kind of equity gain or loss would there be in your P&L? So the rule is certain gains and losses relating to equity instruments are excluded from globe income. So if you take your P&L, there could be different gains or losses, right? There would be fair value changes, FVPL, right? FVPL would be there. So if you have FVPL, gains and losses from change in fair value of ownership interest, except so other than portfolio investments, portfolio shareholdings. What is portfolio shareholdings? Less than 10% and less than 12 months. Those, if you have a fair value change, then you have to include. But other than portfolio investments, if there is a fair value change in your P&L, exclude that. Okay, whether it is income or loss, right? Yes or no? Now, there might be equity method P&L income also. So what happens if you have an associate, IAS 26 maybe, right? What will happen? You just take the proportionate share of the profit of that associate, put it in your investments and put it in P&L. So the entry would be like investment in associate to profit and loss, right? The equity accounting thing. Now, in such a thing also, you can remove that. No questions asked. If you see such a profit share of an associate, remove that. And also, if you dispose gains and losses from disposition of ownership interest, except portfolio share. So, if you dispose of any shares other than portfolio shareholdings, or if there is a fair value changes, FVPL items, FVOCI items don't take. Why? Because we are only taking net profit after tax. We are not considering the OCI item also. So I don't need to adjust OCI. So FVPL items as well as capital gains on disposal, if they are not portfolio shareholdings, exclude. Okay, but the problem is here dividend was always an income. Here it could be income or losses on all three. Okay. Okay, fine. Now what is portfolio shareholding? For portfolio shareholding, it's less than 10% and held for less than 12 months. So for those cases, you have to include fair value changes as well as gains on disposal. Clear? Now let's do a little example. So let's say that I have a fair value gain on AQ Netherlands shares, who's a subsidiary. The amount in my P&L is 120,000 credit, well, 1.2 million credit. What should I do? Yes, I should exclude or not? The answer is coming in. Ashik says exclude, just no says exclude. Perfect. Share of JJ Japan. I like the triple J. So it is my associate. So I have this share of triple J profit. What should I do? Exclude, because equity instruments no need to think of anything. It will never be a portfolio investment because the law itself says it is 20 to 50%, correct? So it will not be a portfolio investment at all. So if you see such shares, exclude. Now, gain on sale of 5% stake in SA Limited. I held it for only 8 months. What should I do? Exclude? Exclude or not? I sold. This is disposal. Number 3. Gain on sale of 5% stake in SA Limited, which I held for only 8 months. What should I do? I should not adjust because this is a portfolio shareholding. I only had less than 10% and less than 12 months. Okay. Assuming that 5% was all I held in SA. Okay. Okay. Now, fourth one, loss on sale of 15% stake in MJ Startup Co. This I should not exclude so that loss will remain like that because it is not a portfolio investment. Yes or no? It has more. I have more than 10%. Any doubts? Okay. So any doubts, you let me know. I see some doubts coming in. Okay. So you said that. Okay. I didn't concentrate on the chat. So okay. So this I will not adjust. I will only adjust this one. Number 3. Okay. What I will do from my globe income, I will deduct this because it's a gain, right? Yes or no? This gain is included in my globe income. It's a credit side of my P&L. I'm going to debit it by minusing it. Yeah, if there are any doubts, you can open up and speak in the class. No worries. Yeah, no need to type. You can chat. Shall I move on, or you have a doubt? You can speak. No need to type it out. Yeah.
This
Yes.
third one, gain on sale of, we have to
Yeah.
deduct, right?
We have to, yeah, deduct from my profit. I will minus because it's already included in my globe income. Sorry, in my net profit, right? It would be there on my credit side of P&L. Now I am minusing it so that my profit is without it. Now let's assume that loss on sale of MJ startup. Let's say this is also 5% stake. What would I do? I will add back. It's just pure reversal. What is so confusing about that? It was already included in globe income. Deduct it. If it is already subtracted from globe income, add it. Okay. It's pretty straightforward. It's just direct debit and credit. Okay, I hope it is clear now. Anyways, you can now feel free to open up and talk. There is no problem. We can have mutual discussion. All right. If this is clear, then there is some another election. I told you there was an election in dividends case. There is an election here also. And M&E group may elect to include all excluded equity gains, losses in globe income. Now let's say that I again don't want to segregate whether it's a portfolio or non-portfolio. I don't want to get into the compliance risk. I can take a unanimous option that all these items except equity method P&L, fair value changes and disposal of gains in respect of all assets, all equity investments are going to be included in my globe income. Okay, I don't need to cherry pick and do plus or minus like how we did in this example. I can take an option that everything would be included. Okay, except the equity method part. Clear? So that will save up my lot of compliance costs. And of course, like the dividend part, it is a 5-year election available on a per jurisdiction basis. So that means even if you opt in one jurisdiction, you can opt out in another jurisdiction. Okay, clear? You may type just the letter yes in case if you don't want to type YES. Anyways, so this is excluded equity gain loss. This is number 3. So it simplifies tracking. Okay, I think. Now number 4 is revaluation gain or loss. Okay. Now, what is the rule? Gains and losses from revaluation of PPE that are recognized in OCI under revaluation model may be included in the global. Now, what happens when you have a revaluation profit or revaluation gain? Where do you take it to? You take it to OCI. You don't take it to P&L. Correct. So, if there are such gains there, you have to include it in P&L. Not just gains, but losses also. So, why this adjustment? Under IAS 16, entities may choose revaluation model for PPE with gains going to OCI and not P&L. Without this adjustment, such gains would escape the globe income calculation entirely. So they want to tax revaluation gains. Okay, because see, if I have a revaluation gain, what is my depreciation expense would be more no next year. Correct. So I get a more depreciation expense, but this gain is not taxed at all. That's not fair. So in such a scenario, what they are telling us, if you have revaluation gain in OCI, bring it into the globe calculation. So add it. So see, if you really look into this, you will see that revaluation gain on PPE is never in P&L. It's always in OCI. So that you have to pluck it and include in globe income. Now there is sometimes what happens is revaluation loss would happen. Now what is the accounting for revaluation loss? If you have a revaluation loss, what would you do? We discussed this in length during our discussion of IAS 16. What do we do if there is a revaluation loss? What I will do is up to the level I have a revaluation reserve, I will cancel that and remaining will go into P&L. Correct. So up to the level in which I cancel, it would be there in OCI. Yes or no? So that's why revaluation loss would be sometimes in P&L, sometimes if it in OCI. So if there is revaluation loss on OCI, that OCI also you include into the globe calculation. Whatever is in P&L, it's already included, so don't bother. Yes, simple reason because I am going to have a reduced depreciation going forward in X number of years based on the life of the asset. So it makes sense to put the revaluation loss also now. Same logic reverse. Now, if there is an associated deferred tax, so what happens is this is a timing difference. No revaluation. We in tax in our corporate taxes, what happens is I have an option to take unrealized income or losses. Correct. So this is an unrealized gain revaluation. Yes or no? So there would be a potential for deferred taxes if I don't choose unrealized gains. So in case if there is associated deferred tax, so whenever there is a deferred tax based on an OCI item, that will go into OCI. When there is a deferred tax based on a P&L item, that will go to P&L. This is pure application of IAS 12. So if there is a deferred tax element of a revaluation loss in OCI, don't touch it. Let it be there. So that we will take it in the covered taxes area. So deferred taxes, I told you, if deferred taxes are in P&L, don't touch it, don't adjust it. Deferred taxes in OCI also through revaluation losses, don't touch it, don't adjust it. Okay. Is this table clear to you? Perfect. So whatever is in OCI, you have to bring it in globe calculation. And M&E, there is a realization method election also. So just like we have a realization election in CT, there is a realization election here also. And M&E may elect to use realization method instead of fair value accounting for globe purposes. Under this election, fair value gains are excluded till asset disposal. Gain or loss crystallizes only on actual disposition. So I can take a 5-year election, which is applicable to all assets and liabilities, or only tangible assets, or only investment entities. Okay, this reduces volatility and unrealized losses and gains. So if I take this option that boss, I don't want this revaluation to be included, I will take a realization method election. Then don't forget about this revaluation gain in OC. Okay, I think it would be very easy for us to understand because that's what we do practically in the domestic taxes framework also. Yes. Don't worry, we will chart out a map of all this. We'll refresh, but just understand and go what is there on the screen. Is this clear revaluation gains or losses? And why it is included, even though it is an OCI, we are adding it back into the P&L. Why are we doing that? Because of depreciation calculations. Yes? Clear? Okay. Fantastic. So that's 4. 5 is gains or losses from Article 6.3. Article 6.3, we will talk about it once we reach chapter 6. But I would say it is very easy for you to understand this one. This is nothing but gains and losses from intra-group asset dispositions covered by Article 6.3 are excluded from group calculations. Now, let's not talk about 6.3 and all, but you understand intra-group asset dispositions which are covered by Article 6.3. So, what does 6.3 cover? Article 6.3 provides rules for reorganizations and asset transfers within an M&E group, including asset transfer at book value, carryover of tax attributes that you leave it, and certain corporate reorganizations. So, what is this basically? What is this basically? Yes. What is this basically? What is this 6.3 in terms of our domestic taxes? Asset transfers at book value or certain corporate reorganizations. What is this? I think we had a discussion about this today. If I don't, if I remember, we had it this morning. Yes. Yes, this is business restructuring relief as well as qualifying group relief, asset transfers at book value. So we will talk about 6.3 when we reach chapter 6. We are in chapter 3. But you understand if there is anything related to 6.3, like asset transfers at book value, carryover of tax attributes, or certain corporate reorganizations, if such income is there in your P&L, remove them. Okay, no need to include it. Asset transfers may create a profit or loss, so remove all those things from the P&L if there is. Okay, so practically, just to understand, if there is an intra-group sale of asset at arm's length price, say if the book value of the asset is 5, but I am selling it at the arm's length price of 20, then let that be there. Okay, gains and losses recognized normally, which is not an Article 6.3 exclusion. But intra-group asset transfers at book value is a qualifying reorganization, and gains under that is excluded. Now, fundamental question you could have is, if I transfer something at book value, why would there be a gain in P&L? You will understand that once we go to 6.3. Okay. But for the ease of this chapter, because I don't want to bring too much information, uh, asset transfers at book value or certain corporate reorganizations or carryover of tax attributes. If there is a reorganization and if I have a, carry forward loss also, would that be there in the P&L? Would that be there in P&L in my company books? there would be a deferred tax asset for sure. So that carryover will create, like, carryover of tax attributes also at the time of reorganization. So those things and certain corporate reorganizations, we will discuss this in chapter 6.3. These, if any income or expense relating to that, do not include in GLOBE calculation. Adjust from net profit and loss. Clear? Okay. Fine. So that is 5. Then 6. Asymmetric foreign currency gains or losses. Okay. Now things will get a little tricky. So look at every time when we talk about forex, whether in P4 or we had something called MAFA back in CA, or we have IFRS foreign currency also. Foreign currency is always tricky, right? So there are something called asymmetric foreign currency gains or losses that you have to include or exclude. If include if it is a loss, exclude if it is a gain. Now, what is this asymmetric foreign currency loss? Adjustments are required when accounting functional currency differs from tax functional currency, creating an asymmetric foreign currency gain or losses. Okay. So let's understand this and then we will take the questions. So when does asymmetric foreign currency forex arise? So if you're accounting in GBP, but the tax returns are your functional currency, or your accounting statements are prepared in GBP, and your tax returns are filed in AED, right? Transaction in AED creates FX gain in GBP accounts, but different or no FX for tax. Functional currency mismatch. UAE subsidiary of UK parent with AED tax filing. So if there is a functional currency mismatch, or your accounting and tax returns are in different currencies, then yes, there could be an asymmetric foreign FX problem. Okay, there are three scenarios where it materializes. When the transaction in accounting currency creates taxable foreign exchange gain, when transaction in tax currency creates an accounting foreign exchange gain, or a transaction third currency creates an accounting forex gain. So you should only include if it is accounting currency is creating a taxable FX gain. Clear? Yes. Sahil says yes. What does it mean, Sahil? Asymmetric foreign currency. I was just purposefully, like, wanted to brush through for you guys to understand if you want to go home very fast, or you want to continue to learn this. Trust me, with the explanation I gave, I don't understand anything. What is this asymmetric foreign currency? Let's take a moment and understand, because this is not very simple as it looks. Let me give you a context for you to easily identify. So let's open a spreadsheet. Can you see my screen? So what is an asymmetric foreign currency game? Right? Not FC. So basically, this problem arises when, for accounting purposes, you have one currency. Let's say GBP, and for tax filing is filed in other currency. Let's take AED. Okay. So there is an asymmetry in accounting and taxes. Yes or no? Now, how does this asymmetric or the symmetry does not apply? So let's go to back to our presentation. This arises in three situations. Okay, transaction in accounting currency creates a taxable FX gain, and there is a tax currency difference. Okay, so what this mean is that the first scenario, So let's imagine that I have an asset. Okay, let's say cash. Okay, so I have a cash of GBP 100,000. I have in liquid Great Britain pounds. My business has, uh, you know, and I have it as my cash in my petty cash. Now, scenario one is the exchange rate is, while I acquired this was 1 GBP, uh, you know, 1 GBP equal to 480. Okay, this is what I had acquired this currency for. Can I have a cash as my asset? Right? For the simple basic purpose, I'm saying it is cash. Now, is there any change in the accounting? Is 100,000 going to be 100,000 only? Yes or no? Correct. But in tax, let's say that at the time I'm filing, AED equal to 5, GBP equal to 5 AED, right? So there would be no foreign currency gain in my accounting, but in tax there would be an at the time of conversion, at the time of doing this, wouldn't there be a gain of 100,000 AED? Yes or no? How did I get 100,000 AED? Because previously it was 4, and now at the time of conversion it is 5 AED equal to GBP. Wouldn't I have a foreign currency law gain of 500, 100,000? Yes. So what happens is this 100,000 AED gain would be taxed by the tax authority, not in UAE, but in certain cases, what happens is it will not be included as an accounting income, but at the time of tax filing, because of the asymmetry, it would be calculated as a taxable gain. Okay, so this our taxes would be paid in this, including this 100,000, but it would not be there in accounting. So in such a scenario, what should you do? What should you do? Because end of the day, ETR is equal to taxes paid divided by globe income. So if this is not there in my income, that would say I paid more taxes. Yes. So if it is not included in the accounting figure but included in the tax figure, then in globe income you include. Okay. Getting this? Otherwise, it would create an asymmetric distortion. My ETR may be more than it seems. Yes or no? Did you understand that point? It is included in the tax calculation, but it is not included in the accounting calculation. So my ETR would be calculated using the covered taxes, which would include taxes on this as well. But my denominator would not have this. So that creates a distortion. My ETR would be deflated or inflated without proper justification. So you have to include. Now let's look at second scenario. Hmm? Let's say that I have a reverse. Okay, the accounting has a let's say that I have AED also. Let's say I have AED also with me. Okay, so AED, let's say, appreciates because dollar is doing good, so AED also appreciates. So I would have a similar way. I would have 100,000 AED gain in my accounting. Okay, but I have nothing in tax because it is AED and AED end of the day. Yes or no? So in such a scenario, do not adjust. Do not adjust. Okay, if this is more and if it, yeah, if it is the reverse, if accounting income already has this but tax does not, then you can kind of like, keep it that way. This is called an asymmetric foreign currency gain or loss. It's what you have to, what they are specifically doing this is, if they are matching it with the tax amount. Okay, in this such case, do not do any kind of changes. There could be a scenario 3 also, that is foreign currencies. A transaction in third currency creates an accounting gain. Now, if there is a third currency, let's say that I am a country where I borrow in, I am a country, so I use INR as my functional currency, but I borrow in JPY. Definitely in accounting, there would be a problem. I borrowed in JPY, and at the end of the year, IFRS, whatever it is. What is the IAS? 11. Yeah, it tells me to restate my balance in INR terms. So there would be a problem in my accounting figure, plus or minus. My liability may increase or decrease based on that there is. But for tax, would we take it? There are situations where we don't use that for tax calculation because it's a notional unrealistic loss. So in such a scenario, do not adjust. But if it is reverse, yes, adjust. Okay. So this is what we call as asymmetric foreign currency gain. What is, it typically happens when your functional currency is not equal to your tax reporting currency. Now let's go back to this and understand. So if there is a transaction in accounting currency and it creates a taxable FX gain, transaction in, transaction in accounting currency creates a taxable foreign exchange gain, then yes, please include. And there's a transaction in tax currency that creates a foreign exchange, then exclude. Transaction in third currency creates an accounting gain, then exclude. Understood? So what they're effectively telling me is this also, like, you have to remove, not do anything. This also remove. This also, like, adjust. Let's use the word adjust, like, so that your covered tax and globe income does not have any differences. Okay, the tax base used here and this does not have any minor differences in respect of foreign currency asymmetry. Are you understanding? That is the key no thing about this asymmetric foreign currency gain or loss. It is a little thing, but you just understand our tax and accounting should match. If something is included in tax but not in accounting, include now. Something is included in accounting but not used in tax calculations, exclude it so that in both that is not there. Okay. And if it is a third currency, based on what the tax says, you have to plus or minus in the accounting. Clear? So from this asymmetric position, you have to bring symmetry in your ETR and globe income. Okay? Yes or no? Can you give me some? Okay, fantastic. So we can discuss this offline as well, like, if you have any problems. So this is asymmetric foreign gains. If you understood this, the other adjustments are pretty simple. Seventh one is policy disallowed expenses. Again, this is something at par with UACT. What they say is certain expenses are added back to globe income because they are disallowed on policy grounds. Now, what are these? Bribes and illegal payments. Any threshold, any amount you have to add back. Okay, this is something plain and simple as it is there in the CT law. If there are fines and penalties which is more than 50,000 euros, add back. If there are fines and penalties up to 50,000 euros, you don't need to do any adjustment. Okay, for globe income. Now, what is not a fine and penalty? See, fine and penalty is a very abstract word. So they have given some clarity as well. So interest on late payment is not a fine. Okay. So you don't need to add back and all. If there is interest, anything which is interest on late payment. So basically your 14% you don't need to add back. But your 500 or 10,000 as the case may be, it is a fine. So you have to add. Getting it? Okay. Compensatory damages. If we are paying some compensation for the damages caused to the other person, that's not a penalty. Okay. Or a fine. Contractual penalties, example like late delivery or contractually it is written, then also it is not policy disallowed. What is disallowed is kind of like fines and penalties not in the nature of these three things: traffic fine, parking fine, red light fine, amortization rule being not followed, so fine. Those things will all be added back, provided it's cumulatively more than 50,000 euros. Okay, fantastic. Then eighth one is prior period errors and changes in accounting policies. I know it is a drag, but can anybody tell me what is the corresponding accounting standard? I think this was the first accounting standard we discussed while we were having the accounting standard classes. Prior period errors and changes in accounting policies. I'm sure somebody has mentioned IAS 8. Okay, fantastic. Thank you, Ashik, for that. So, what happens in prior period errors? How do you adjust prior period errors? If it is a prior period error, you have to do a retrospective amendment, right? Retrospective adjustment. What about changes in accounting policies? Accounting policy is also retrospective assessment, correct? If it is accounting estimate, then it is a prospective adjustment only. You remember all these from IAS? So now if you see something like that in your P&L, what should you do? When you come, so adjustments are required for prior period errors affecting current year opening balances and changes in accounting principles with retrospective. So if you see any error in prior period globe income, so there is an error. Okay, you have to recalculate prior year ETR and top ups. You remember while doing the jurisdictional formula, chapter 2.4, we said there is like, plus or minus something which is coming back from last year. You remember? That is this. So if there is any prior period error in respect of last year's income which is put here, then you have to take it into the last year. So recalculate prior year ETR and top of that. You have to recalculate that. So that adjustment will come in while you're finding your jurisdictional ETR. You remember? Excess profit into top up taxes plus prior year adjustments minus QDMTT. You remember? So that you have to recalculate your charging provision here. But if the error only affects the current year accounts, adjust current year globe income. Error creates additional top-up tax, include the current year as well. So that's what 5.4.1 is now. Error creates additional top-up tax, including current year. That's what we do. So when you see an error which is previous year's error, ignore that from globe income, but you bring it as an adjustment at the time of finding jurisdictional top-up taxes. Okay? Yes. Fantastic. Now, treatment of accounting policy changes. Now, if there is a retrospective replacement, apply the same change to globe income. That is, if there is a retrospective application and changes for that is coming this year, then you have to kind of take it to recalculate last year's and you would include that in charging provision. You will not include it here. If it's a prospective retracement, then no need of any adjustments. Okay. Fantastic. So this also is something that you have to take care. Then there is accrued pension expense. You remember defined benefit schemes, defined contribution schemes. What is the difference? So same. So adjust financial accounting net income for difference between pension expense recorded in accounts and contributions actually paid. Now, what does it mean? You should not take the accrued amount. See, if you remember IAS 19, I think that's the standard. We are accruing the defined benefit expense on an yearly basis, correct? Say for example, Mr. JJ is going to leave only after 60 years, after being 60 years old. So we have to give him that defined contribution, only defined benefit only when he turns 60. But do we kind of like put an accrual to it every year, right? We accrue his expense every year, like of the years of his service. For accounting, we would kind of, even though my payment is say years afterwards, but what is the amount relating to each year, I'll just accrue it in this year only, correct? That is IAS 19, employee benefits. Now same, you should only take contribution paid, not the accrued accrual. So if accrual is greater than contribution, deduct from globe income. If accrual is lesser than contribution, add to the globe. So basically what they're trying to say is, what is the contribution you made to the fund, that has to be deducted, not the accrual amount you put in period. Okay, why? Because certain tax authorities would only give a deduction for this contribution, not for the accrual amount. So to bring a basis for that, so that my ETR is not asymmetric, what they have done is same. You would only given for contribution, not accrual. Is this clear? Okay, why? Because align globe income timing with tax deduction. Most jurisdictions allow deduction when the contributions are paid, not when the expenses incurred. And defined benefit schemes can create significant accruals, not reflecting it. That's also one question I want to ask you. Does this apply to both defined benefit schemes and defined contribution schemes? It would only affect defined benefit scheme, because here we are, that's where we are only providing an accrual. In defined contribution scheme, we are defining a contribution that we are paying to a fund. So actual contribution happens every year to a designated fund, so that you can take as an expense. But the accrual that you are doing based on actuary findings and all those estimates, that is what's not allowed. You can only put what is actual contribution made to the fund. Okay, we had a detailed class on IAS 19, if you remember. Okay, is this clear? Like accrued pension expense, only take the actual contribution and not the accrual amount. And then stock based compensation. Now there is IAS 2 stock based compensation, correct? The M&M elect substitute tax deductible stock compensation for the accounting expense. So basically what it means to say is, if it is an election, okay, it is an election. So what you can do is, you can take tax deductible amounts. That is, what is the contribution actually paid? I can only take the contribution, or I can take the accrual. It's an election, what I should take. Now, if I don't elect anything, then whatever is the accrual will be my, I won't do any adjustments. But if I elect saying that stock based compensation would only be on the tax deductible amount, then you have to adjust that. Clear? What is the stock based compensation? Let's say, for example, I would pay AQ a stock based compensation after 3 years. But what do I do? I do accruals in year one, year two, year three. Correct? So those will not be, you have two options. Either you will take it for year one, year two, year three, or you will take it at year three when you're actually giving him the option. So if you don't do anything, whatever is accrual will be your expense. So don't adjust globe income at all. But what if you are taking the option, then you have to add back that accruals you have put in your profit and loss, and you should only consider the contribution at the end. Clear? Stock based cost. So SBCs often create a book to timing difference, accounting expense over vesting period, but tax deduction at exercise or vesting. So tax normally like UK and all, they would only provide a deduction at the time of exercising. So that creates a temporary difference. So without this election, these timing differences could create an artificial top-up tax. So what they're saying is, if this deduction is there, okay, but I'm not paying taxes for that, then I would have a, if I elect no, then this expense would be there, but I will be paying lesser taxes also. So the same thing can apply. So this is only to bring in symmetry. Okay. And if you take an election, this is an irrevocable election. Last few elections, I told you it's a 5-year period, but this election is an irrevocable election and applies to all stock-based compensation for the constituent entity. Yeah. So let's do we that's the 10 things we found. So let's do one thing. Let's kind of like list that out for memory. Memory alone. I don't think there is a problem in understanding at all. Yes. So which was the first one? If you take this, what is the first one? First one is net tax expense. Correct? So this is, let's learn 3.2.1a is net tax expense. So you don't remove deferred taxes or other indirect taxes, only the direct taxes you have to remove, or direct taxes or the covered taxes you will be removing from the thing. What is second one? Second one is 3.2.2, sorry, 3.2.1b. Let's understand the also. It is excluded dividends, right? So excluded dividends, what is excluded dividends? Those dividends which are not short-term portfolio holdings, then it is an excluded dividend. But of course, let's put it there that there is also an option which I can take, right? What is the option? All portfolio share dividends I can just include. I don't need to calculate 12 months. Correct? So whatever is like short-term portfolio option I can take. What it basically means, like only look at 10% is met, 12 months not considered. It is a 5-year election. Yes or no? Now that is the third one. Third one, 3.2.2, 3.1c is excluded gains and losses. So any excluded gains and losses other than from the short-term portfolios, I can kind of do it again. Here, what they say is you can include everything. Include all, also include all gains as an option. But of course, it is a 5-year election. What is the fourth one? 3.2.1d is revaluation gains or losses. Right? But here also I have an option where I tell them that realization. So I have a realization option, and this is also for yes. Now, this is one batch. Now, what is 5? 5 is, or E is, Article 6.3. Article 6.3 incomes and gains. What is nothing but business restructuring relief and qualifying group relief? Yes. Now, what is sixth one? Just as a summary, guys. What is sixth one? Sixth one is asymmetric effects. So you have to see whether tax and accounting is going hand by hand, and if there is any asymmetric foreign currency income or losses, you have to adjust it accordingly. Then seven is what? EFG. G is policy disallowances. Correct? Policy disallowed expenses, which is nothing but penalties, fines, and bribes or other illicit payments. Bribes or illicit payments without rate. Policy changes. What you have to see is it should have EUR 50,000 limit. Correct? Then only those fines would be excluded. Otherwise, those fines will not be excluded. Then what is AFGH? H is prior period errors and retrospective amendments. That also, if you see any prior period errors, adjust with the prior period one. Then 3 point I. I is nothing but pension contributions. Right? Only the cash contribution to be taken, not the other things. Then there is 3.2.2, which is an election basically. So I will color this in green because this itself is an election. And this is what? Stock based compensation adjustments. You can opt to do this on accrual or at the time of exercise. So these are the mandatory adjustments, guys. Yes. So these are the 10 adjustments or 9 adjustments and 4 elections. Okay. Easy to understand, but let's do a little practice. So one last slide. So let's say that AQ Germany GmbH has we are doing its 2025 globe calculation. The financial net accounting income is 4.9 million. Net tax expense is 2.1 million. Excluded dividends is 450. Fines and penalties 180. Pension contribution is this. What would I do? 4.9 million. Do I add back 2.1 million? No, I will only add back current tax element, deferred tax, I will keep it there. Okay. Now, dividends received from JJ France, that I would deduct from 4.9 million because it's a 100% subsidiary. It is not a short term portfolio holding. Okay. Now I got an environmental fine of 180,000. It is more than 50,000 euros. And of course, it is an environmental fine. It is not damages, compensatory damages, or late payment interest. So this what I will do, I will add back. I will add it to 4.9. Then pension contribution, the accrual contribution is 320, but the accrual is 320, the contribution is 280. So there is a 40,000 difference. What do I do? I told you pension contribution, we can only take the contribution amount, not the accrual amount. So 40,000 is already added. So this I would add back. 320 is taken as a deduction. So I'll add back 40 so that the deduction is only 280K. So from 4.9 million, assuming that 2 million is current tax and 100,000 is deferred tax, 4.9 million plus 2 million minus 450 plus 180 plus 40. Getting it? Yes, that would be my global. So these are just mandatory adjustments, but we have more. But always take care. Remember these 10. Okay, 3.2.1a to 3.2.1 I and 3.2.2. Why I'm writing these numbers is because if you write these adjustments along with these numbers, it's extra brownie points. Okay, but never kind of like so if I can tag them in boxes, what I will do is, let's say from 3.2.1 to this is, so first five is what CT has. Correct. Even if revaluation gains and losses are not plucked back, but I can say that realization option is there. So all these are what I will do it as CT adjustments. Correct. Now from F to I, even this is a CT adjustment. Policy disallowed. But F to I are IFRS disallowed. IFRS things. Okay, asymmetric FX, pension contribution, and stock based contribution. I'll do this. So all these except this guy will go up. All these are again accounting versus tax adjustments. Tax versus accounting symmetry. Okay. So this is the mandatory adjustments. Any doubts there? It just will come with it will come with practice. Don't worry. Okay. Any doubts there? Yeah. So I hope this is fine. It is just mandatory adjustments, but it will take a lot of time if you read to understand the rationale. So that's why we were pushing it now. If there are any doubts, we can take offline also. But thank you for your continued participation. And we will not have classes tomorrow. We will have it day after. Okay, on Thursday. Right? So till then, revise and I'll see you next class. Bye bye.